And so I'll have, clients come to me and say, hey, I'm going to buy this property and I'm going to depreciate 100% of it the first year. And so hold on. First of all, part of the purchase price is going to have to be allocated to land, most likely, unless you're buying a condo or something
Right.
like that. You can't depreciate land. And then also even what's going to qualify for that bonus depreciation likely isn't going to be it's not going to be the building and the structure. It's going to be those internal components for the most part.
Welcome, my fellow Flow Masters, to another episode of the Cash Flow Authority podcast. I'm your host, Chris Jansen, founder of the Flow Authority. This show is for high-performing professionals who did everything right, the degree, the career, and the income, but you still feel like there's just something waiting. There's another level waiting for you. Here we explore how real estate can become that next challenge worth building so that you can take ownership of your future and create a life by design. Now, today, we're joined by a special guest, Ms. Susan W. Jones. Susan is a seasoned wealth management expert. She's an attorney, a financial advisor with over 25 years experience in tax, estate, and investment planning. She is the managing partner of Sorelle Wealth Partners, a fiduciary fee-only firm specializing in personalized financial strategies for women navigating major life transitions. And Susan's background includes leadership roles in international law, national accounting, and a top 100 registered investment advisory firm. So welcome, Susan. Really happy to have you here. Thanks for joining the show today.
Thanks, Chris. I'm excited to be here.
All right, so jumping right in, the big picture of wealth. So how should, with this being a real estate focused podcast, how should real estate investors think beyond the individual deals and really start working to build a long-term wealth strategy?
Yeah, Chris, I work with a lot of individuals who are involved in real estate. So whether that's developers, just making more passive investments. And one of the things that I see time and time again is a focus on income and not as much a focus on the balance sheet. And so whenever we're talking about longer term planning, it's really looking at both of those and making sure that as you're building wealth and building income, that also that balance sheet is strong as well, just to provide flexibility later on.
Gotcha. Yeah, so I think it probably varies based on the investor, but a lot of us getting started, we really care about the cash flow and nothing else. It's just like we want the passive income, we want to be able to free up our time and all that stuff. So I totally get that. And then so when you say balance sheet, there's a lot to that, but are you specifically talking more about putting a large enough down payment or just having enough liquidity, or what are you looking at for that?
Yeah, really both. And so I think of it as, and again, cash flow is really important, right? But making sure that there is enough liquidity, making sure that you're not too leveraged and looking at kind of that debt to value ratio. And also then starting to think as you progress in real estate about diversification and the risks of concentration. And that can be both in real estate itself, and to the extent that you're investing in real estate, is everything in the same market? Do you have all the same types of real estate? Even what's your tenants, what's their cadence, and thinking through just to make sure that you have that first level of diversification. And then especially as you progress, one of the hardest things is to tell someone that, hey, what you're doing that's really worked well for you, that's growing your income, growing your balance sheet, but let's think about doing something else and diversifying a little bit out of real estate. And again, I know we're talking about real estate today, but when we're looking at that holistic financial planning, starting to think through, do you have more liquid investments that can provide both emergency funds, but also, again, just more of that broader diversification as well?
Gotcha. Okay, that makes sense. I know, a lot of investors, especially new investors, like we want to get in with as little money down as possible. We don't have much fun, so we're like, hey, let's get in there with as little as possible, and let's see if we can get 100% leverage and all that stuff, which is exciting and fun and great.
Yeah.
But then, what happens when shit hits the fan, which it will, right? What happens when you need a new roof, or you need a new furnace, or one tenant's getting evicted and another one's going through bankruptcy court, right? And then it goes back down to what class of properties are you having? And therefore what type of tenants are you attracting to that property? So yeah, there's a lot more to uncover. Like a lot of people go into this and it's so simple. It's so easy.
Yeah.
I can just run the numbers but it's, in my opinion, the ones that are focused, and I'm guilty of this, but the ones that are focused strictly on, I need massive cash and cash return, usually end up with the C and D and D minus class properties, because those are the ones that pay high cash on cash returns. So then you end up with other issues down the line. So there's more to consider than just one thing. So I love that. I love the holistic approach.
Yeah, that's so funny. The roof example is what I always say. What are you going to do what happens to the roof? And I think and that's so interesting too, because it's not even, I'm thinking through how much is your debt to value. A lot of that too is just, again, what is the emergency fund? And I think real estate investors in particular, it's a very optimistic group, which is great. And that, but so I'm a big believer in plan for the worst and hope for the best. And I think that really is true, again, when you're planning for real estate as well.
And we can be optimistic, but you got to remember, like, the only reason that most of the time there's deals to be had because somebody else was optimistic and didn't know what they were doing. So they got in over their heads, and now, they're stuck with something that they got to get rid of. Awesome. Transitioning over to the tax conversation, a lot of people also get into real estate there are some absolutely massive tax benefits. What tax planning opportunities do real estate investors most often overlook?
Yeah. I think one of the biggest ones that's overlooked is just depreciation. I would say both overlooked, but also misunderstood. So depreciation can be an incredible benefit. And particularly if you have the opportunity to do like a cost segregation study, where you're essentially buying a property and then having someone come in and break it into smaller pieces so that you can depreciate it a little bit faster. And we're in the golden world of depreciation right now, so bonus depreciation is back on the table. But what I sometimes see, especially with new real estate investors, is that, there's a lot of great material on the internet. I like the internet as much as everyone else, but sometimes it doesn't go into enough detail. And so I'll have clients come to me and say, hey, I'm going to buy this property and I'm going to depreciate 100% of it the first year. And so hold on. First of all, part of the purchase price is going to have to be allocated to land, most likely, unless you're buying a condo or something like that. You can't depreciate land. And then also even what's going to qualify for that bonus depreciation likely isn't going to be it's not going to be the building and the structure. It's going to be those internal components for the most part. And so really understanding what that benefit is. And again, it can be a great benefit, but sometimes I've seen where people get disappointed because they read an article on the internet and then do planning around that. So I think first, just be realistic, actually work with a professional and make sure you understand. And then also do great record keeping. One of the things, and we're all guilty of this, is that, and I think, again, I love working with people involved in real estate because it's fast, there's a deal, got to get it done. And you can get so busy doing all of that all of a sudden it's tax time and you haven't kept the records that would really help with some of that, either depreciation or other deductions. And all of a sudden then you're trying to recreate, and that's where things get lost. And oftentimes we talk about all these really advanced tax strategies, but some of it's just, hey, make sure you keep record, make sure that you're doing your books in a way that you're going to be able to catch everything. And so that's a lot of it as well. And then for people who have been more involved in real estate, as you go to consider selling and purchasing new properties, 1031 exchanges are still a great way to do that. And one of the things there is that it's very rule specific. And so that's another thing where you really can't go back. And so you have to be very careful as you're going through that process to make sure that you very strictly comply with a lot of the time limits and rules around using an escrow agent or a third-party intermediary. And because I've seen people get a little bit where they think, oh, again, I read an internet article, I'm just going to have the money sent to me, and all of a sudden blows up what could have been a really beneficial 1031 opportunity.
Wow. So it sounds like working with the professionals is a good idea. Real estate's not something you want to do on your own. If you're just going to do one deal and just house hack and then that's your only deal you ever do, okay, maybe. But if you're doing this as a long-term wealth building strategy, you want to work with professionals. So good. And there's a lot of misconceptions out there. I had a friend who told me, because how you explained the cost segregation and bonus depreciation is, and I'm not an expert in this, but that's how I understood it, was it's not, you're not depreciating the entire 100% of your purchase. That's not exactly how it works. I knew about the land, but I told that to my friend. He's like, oh, you should look it up. It's 100%. It's everything. You write off the whole thing. And in fact, I did. I Googled it, and even right away, Gemini was like, yeah, you can write off the whole thing. And I'm like, I don't think that's right. I'm like, because oh, AI said it must be true. It's, oh, the internet said it must be true. But yeah, it's not.
Yeah.
So I don't know.
I love
Yeah.
AI. I really do. But that is the one thing it cannot do tax great yet. There's a lot of things
Yeah.
it can do really well, but it's still a little unsure about tax. So I think I have a few years
Yeah.
left until.
Until you're funneled out of the business. Yeah. And then is there like a percent just roughly? So if you can't write off the whole thing, let's say just the part that, not the land, the rest of it, is it like 50% of that asset you think you can bonus depreciate? Is it?
It's really going to depend. It's really going to depend. And so it depends a lot of times for I have some clients that are really into residential houses. And so that's what, and really they have very little bonus depreciation opportunities because the reality is doing a cost segregation on a 25-year-old house or a 30 or 40-year-old house just isn't going to provide enough a good bang for the buck. And so the reality is they don't have a lot of opportunities. On the other hand, I have another client who does a lot of commercial like warehouses and things like that. And so that's something where actually a lot of times, especially if they're specialty, so if it's some kind of specialty warehouse or something, a lot of times the internal components are really valuable compared to the kind of external like steel building or something. And so that's going to be a much higher percentage. And so it really is very case by case. Also, again, for the most part, it is going to take that cost segregation study, which they're not free, obviously. And so there is definitely a kind of a cost benefit associated with that.
Gotcha. Okay. Yeah, 'cause I've looked into it for my smaller properties and my CPA, and then I talked to somebody, two different people, and they both like, yeah, probably not really worth it. I think that's more the cost benefit analysis side of things. But everybody I know in apartments do it. Everybody, they do it.
Yeah. So that can be, again, because when you think about an apartment, the external structure compared to all of those, however many kitchens you have, or there's all these different kind of internal components that compared to the external building is higher in value as opposed to just a residential 2,500 square foot house. I think it's also really important to, when we talk about depreciation, cash is king, and getting that accelerated cash back, oftentimes that's the best thing to do. But there are situations, especially when you're starting out maybe in real estate, if this is your full-time, you don't have a side hustle or even a full-time that provides a lot of ordinary income, it can actually be better to forego the bonus depreciation because you're going to get the benefit of that depreciation in a later year when you're in a higher tax bracket. And again, that's not always the case, but I do think when you're reading articles, it's almost this feeling of, hey, bonus depreciation is the right answer for everyone. And the reality is depreciation, like any deduction, is worth more in a year that you're in a higher tax bracket.
Gotcha. Okay, great. So another big topic within real estate and wealth is asset protection. So what should investors understand about structuring their entities when building a real estate portfolio?
Yeah, one of the things that I see most often, so again, I'm sure anyone listening here has been told if they've worked with an attorney or someone in real estate, that the best thing to do is make sure that you're putting those properties into an LLC, because what that does is it generally limits the liability to the other assets in that LLC. So it provides some personal protection. Now, a lot of times I see clients or prospects really come to me and they say, hey, I did everything right. Here's my LLC documents. And then when I start asking questions about where are the bank accounts for that LLC, let's look at the cash flow. What I find out is that the LLC was set up, but then nothing else was ever done. And so they're still getting rent checks in their own personal account. It's really just maybe the insurance even is still in the individual name and not in the LLC name. And then it's the LLC no longer provides protection, but it could even be a real liability to the extent that, again, insurance coverage and things like that aren't titled correctly.
Gotcha. Yeah, that's a tough one, especially when you start getting a bunch of properties and they're all in different LLCs. Now you need all these bank accounts, and I know some people who they just do single family, and every house they buy is in a new LLC. I feel that's a little bit nutso. That's a little extreme, but because I've talked to attorneys that are like, usually we'll say up to this much equity, then you move over and do another LLC. So I've been on that boat. There's only so much you can do, and there's a cost to each LLC
Right.
as well. But definitely, yeah, that's to me the easy part is just setting it up, but then
Right.
actually treating it like a business, a separate
Yes.
business, and especially you have. This is one reason I like apartments, right? Because and why I'm transitioning, because if you have 100 houses and 100 LLCs, you still have 100 units. That's nice because if one unit is struggling, the other ones balance it out. But now you're dealing with moving funds from one LLC to another LLC, and it gets really cumbersome from a accounting standpoint. So at least if you have an apartment complex, you have 100 units that are at least all under one roof. You get the easier management, and then it's one LLC, one apartment complex. And I think, correct me if I'm wrong, but I've been told that there's also asset protection benefits when you have a bunch of limited partners and things like that. It's a big partnership as opposed to just a single member LLC. I think there's protections that can't just come and make you liquidate your whole building if a bunch of other people are involved, is my understanding.
Yeah, usually there's a little bit additional protection. And the other thing that can be really helpful is if you have properties that, or even your LLC is owned with a spouse, because that's also can be
Okay.
helpful from a liability perspective. Yeah. And a lot of this is
Okay.
like kind of state specific as
Yeah.
well. And the general rule is make sure that whatever you set up, that you honor it. But to your point, there's a lot of different thoughts, and a lot of it just goes to risk tolerance too. Do you
Uh-huh.
have one property per LLC? Do you have kind of
Right.
group them so that you have them separate? And then you can always have the LLCs at the bottom and then the holding company at the top, which sometimes from an administrative perspective can make it a little bit less cumbersome.
Yeah. Because that's how I do it, and I probably revealing too much here right now.
Yeah.
But that's how I do. But then I have a slush fund,
Yeah.
whatever you want to call it. Basically, just a set of reserves in the holding company. So any extra money in the LLCs, I move it up to the holding company, and then that kind of helps. That can flow back down to the other ones, and it's just
Yeah, and that's
contributions,
a
distribution sort of thing.
yeah, and that's a really common way to do it because again, it just
Yeah.
prevents some of that full circular cash flow.
Yeah, for sure. Okay, so next question is about the team that you're working with. And this, in my opinion, is one of the biggest, if not the biggest, element that a lot of people miss. Because everybody, again, tries to do it on their own. They want to just, everything for me, and right?
Yeah.
So when it comes to working with a team, you work across the real estate deal ecosystem. What roles should investors have on their advisory team? What's the
So I'm a
crucial-
big believer in having an accountant that actually deals with real estate regularly, an attorney who deals with real estate, and also a financial advisor that deals with real estate, because those are the three people, and especially, not just having that team in place, but a team in place that is willing and able to work collaboratively, because that's going to, in a lot of cases, pay for itself, quite honestly.
Definitely. And if you're new, you should probably have a coach. And you're
A
speaking to
mentor or
one right
coach
now.
yeah, absolutely. Yeah, because the reality is, even for the professionals like myself and the CPAs and the attorneys that work with those involved in real estate, we're not in real estate ourselves. And so there's a lot of,
Right.
that it's really important to have a mentor or someone who can show you the ropes and tell you what is a good deal, what's not a good deal, and help you run some of that.
Definitely. Because I've been in some deals that weren't good. I took the classes and I thought, I know better. Yes. Better. And I'm just like, I have a good feeling about this one. And I went in on it, and well, turned out my feeling didn't trump reality, right? It's the deal I'm thinking of. I had one strategy that was going to work, and it didn't work, right? And that was it. Didn't work. So it's like either sell it and you lose a bunch of money when you sell it, or you just hold it and you suffer every month. That's what I did. That's what I'm doing. I'm suffering every month, but here's the good thing. It counteracts all my other gains if you look at it that way. So I'm like, hey, my tax return looks good. That's just a terrible excuse. I should have never done the deal. And so you can learn from a coach like me, right? Anybody listening, you can learn from a coach. Don't do that deal, but then listen to them. Somebody has told me, don't do that deal, and I didn't listen to them. So just be coachable, and that'll
But
take you
I
a
think
long way.
this is a really good, and this is true whether it's, that you're buying real estate, whether you're investing in the stock market, you're going to have good deals and bad deals. And part of it is when you're thinking about looking forward and what your portfolio looks like, understanding that at some point, even if all goes right, there's still going to be one that underperformed the other.
Yeah. Yeah.
And again, that kind of goes back to that optimism, and it's good to be optimistic, but also good to be realistic. And so whatever
Right.
you're investing in, you're going to have a dog at some point. Yeah.
Yeah, and it's on that deal again. I just had one exit plan and it didn't work. So now I always try to have at least three. That's
Yeah.
my minimum. I want to have at least three, and they don't. The third one doesn't have to be like they're not all home runs, but at least the three should be making money. But so, at least if A doesn't work, I got B, and then I got C. And if C doesn't work, there's only so much you can do for risk management. Otherwise, you're never going to do anything. So
Yeah.
there's a balance between the two, but there's definitely those things. And again, a coach, a mentor, a community, like if you're bouncing the deal off other people who've actually done deals and know what they're looking for, that's really important. Okay, so thinking now long-term wealth preservation, what sort of planning gaps do you most often see when investors think about long-term wealth preservation?
A lot of times a succession plan or what that looks like, an exit ramp at some point. And again, a lot of people involved in real estate, whether it's investing, development, all of that, it's a very hands-on, right? And a lot of times they're working by themselves, maybe a small team or a spouse or someone that's helping, but it's really them. And so what I see sometimes is people get to their 60s and 70s and even older and don't have a succession plan. And that's when things can oftentimes, I have one client who her parents were in real estate. They had a lot of real estate and really had no succession plan. And unfortunately, when the two of them passed away very close together, there was a lot of deferred maintenance. There's a lot of issues that they had just gotten older and unable to handle some of it. And there's a lot of cleanup involved with that. And so I think that's one of the things that I see the most is just that lack of longer term planning.
Yeah, and in terms of that, another thing a lot of investors look over is, especially if you're just buying one house at a time or one duplex at a time, is the deferred maintenance. You buy it, you have this plan, I'm going to put aside this much for CapEx, I'm going to replace the roof in 5 years. Or maybe you don't even, a lot of investors don't even do that. They're just like, cash flows, I'm buying it. And so you have to think through those things because depreciation is real. It's there for a reason. And so you're getting the tax benefit, but if you don't put that money to improving the property, it is depreciating. It will depreciate over time, and then you're going to start having problems. And there goes your cash flow. Yeah, I think it's really crucial to do that. And the last guest I had on, actually, she said she just hired an actual employee as an asset manager. So,
that's great.
So she's actually looking at, hey, how much longer do we got left on this roof?
Yeah.
And all the mechanicals and the plumbing, and what sort of issues are we continuously having with these tenants, and how can we improve this? And is it the right time? Looking at cost benefit analysis. There's so much you can do with all that. So yeah, that's important, especially when you pass it down to your loved ones or you go to sell, because I'm telling you, when I go to buy properties, almost every time I do an inspection on one of these older homes, there's always deferred maintenance. There's always a lot of deferred maintenance. And they're like, I bought it that way. Okay. You didn't fix it. And so now I'm also buying it that way, but I need something in return. It usually comes back to haunt you one way or another. Yeah, so I think that's huge to look at that long term. And then one question I had, and I think I know the answer, but if you're trying to transition from active sort of real estate investing to more of a passive role, I don't know what ideas come to mind for you. Is there a way to 1031 from a property you own to an LP position on a deal, or probably not? I'm guessing not.
So there are actually some special investments that allow you to do that. So generally the answer is So generally the answer is no. If it's just a partnership that's going to be treated as, because it's not considered a real estate investment, and so you can't. But there are some special investments that are set up. They're real estate trusts that you can actually take like a tenant in common interest or a full real estate interest and 1031 and take back an interest in essentially a trust that is real estate. And so that can be a great way to do it. Also, there's ways to go from, I have one client in particular who went from being very hands-on in doing commercial real estate and owned and operated a number of buildings, kind of corporate offices and things like that. So it took a lot of time. Actually 1031 into farmland, and then did essentially triple net leases for the farmland. And so really turned it into more of a passive investment. So there are definitely ways to do that. And but again, it takes some planning. And what I always encourage clients to do, even when they don't have that kind of change in the near term, but just knowing that, keep a list of your order of your properties. And if you wanted to start down that path, what would that look like? What would be the top choices to turn over, and which ones would be the good ones to keep? And so, kind of to your point, those lower quality where you get lots of phone calls, those might be the first ones that you want to let go, whereas maybe some of the higher quality with the higher quality tenants aren't quite as bad.
Yeah. Okay. Thanks for that. Yeah, that's great. I never even thought about farmland. I know. Yeah. Pretty sure Bill Gates owns a bunch of farmland. I read that somewhere. I don't think he's managing that very actively. It's probably all triple net, and somebody else is dealing with the triple net. He just probably gives them the money, and here you go, buy some farmland.
Yeah, and that's fine to do. You don't have to. If you're active in real estate, it's perfectly fine to do a 1031 into more of a passive investment.
Yeah, awesome. Okay, so then looking to the future, what advice would you give investors who want to create a more intentional long-term strategy?
I think just having a strategy and really being intentional about it. And again, what I see sometimes is, and again, this is why I love real estate investors. A lot of it's about like the deal and is it a good deal? And then they forget to say, does this align with what I want to do? Like what I want my real estate portfolio to look like. And so I would say from day one, now, is it going to go exactly according to plan? No, but have an idea of what kind of properties am I interested in? What's that going to look like? Who am I going to need to learn from or to hire to help me, or all of that? And so coming up with a strategy, so both as you ramp up the strategy to do that, and then if there comes a time that you want to ramp down or pivot, have a strategy for that.
Awesome. In my program that I have a whole segment on your investor identity, which is, I stole this from a class I took. I'm not going to claim credit for the idea. A lot of people talk about your buy box and things like that. But a lot of this translates over to that. What is your identity? What type of properties do you want? What type of neighborhoods do you want to invest in? What areas geographically? What type of tenants do you want to have? Do you want to self-manage? Do you want to hire it out? Do you want to be active? Do you want to be passive, commercial, residential? All those questions, very important to think through. And again, a lot of people don't. A lot of people just jump in. I want cash flow. Give me cash flow. Let me go buy a deal. And then they'll see some shiny object over here. And, oh, I like that too. Oh, I like that. Yep. And there's no clear focus, and they don't really know what they're doing. They're just going wild. Yeah. And I find when I've done that kind of just paralyzes me, and then I do nothing. It's like with marketing. You try to market to everyone, you reach no one. It's the same thing with real estate. Yeah, I love that long-term focus. And it's been great having you, Susan. Before we wrap up, I do want to give you a chance. Where can people find you, connect with you if they need some support on the wealth management and strategy side of things?
Yeah, I'd love to talk to your listeners. You can find me going through our website. You can book an appointment. It's sorellewealthpartners.com, or you can email me directly at susan@sorellewp.com.
Amazing. All right. Thanks for joining the show, Susan. Appreciate the awesome conversation and insights. I know I learned a lot. I'm sure my listeners did too. So yeah, we'll have to do this again sometime.
Great. Thanks, Chris.
All right, thank you. Thanks for tuning in to this episode of the Cash Flow Authority podcast. We hope the insights shared today help you take the next step toward optimizing your finances and building sustainable wealth. If you enjoyed this conversation, please take a moment to subscribe on your favorite podcast platform and leave us a review. It helps other entrepreneurs and investors discover the show. And don't forget to catch the next episode for more insights. Until then, keep mastering your cash flow.